My apologies. Welcome to Sunday Night Futures Live. Tonight we're going to be talking about, is it time to begin buying emerging markets, but ex-China? No China in your emerging market portfolio. We're going to talk about why, in our opinion, that should be your thesis. And this has been a thesis that we've had for a long time. Since the COVID outbreak, 2020, we've been talking about the supply chain disruption. It was the reason why I was bearish on the market going into the COVID breakdown. The markets were still rallying at the initial days of COVID, and then ultimately they succumbed to the pressure. Let me make sure my audio is good here. Thank you, Franklin. Appreciate it. So let's begin first with the opening price action of the futures. I'm going to speak to you a little bit about why we opened up a bit of a bear position, a bearish position last week. But first, let's talk about the equity market. Let's kick things off first with the Russell 2000. It's down fractionally, 0.07%. Let's take a look at the NASDAQ 100. This is going up. I think we're going to move up higher. This is a fairly good setup. And there you have it. We'll probably come back down, retest this a couple of times, but 15-minute charts saying that the NASDAQ wants to move up higher, despite the fact that it's flashing red right now. It has gapped up on the session. The reason why it's flashing red is because we're off the highs of the opening session. That's the only reason. Now, taking a look at the S&P 500, the S&P 500 is down as well, 0.15%, but we are higher than the closing price of Friday. We're red right now only because we are off the session highs. That is it. So technically, we are up right now despite the red that you're seeing on your screen. Let's move on to the US dollar. The dollar was absolutely annihilated last week. It is about flat at current. Nothing much going on here. Let's take a look at commodities. Gold first. Gold down fractionally. I think what we need to do is to really get a good feel for what gold has been doing and why we're so bullish on it. You need to take a look at it from a weekly perspective. Look at this rally. It's been a wild ride, and I think that we're only getting started here. Stepping back, let's take a look at silver, back to a 15-minute chart. Silver, we're long of silver as well. Silver has just been killing it. We are opening down here. We are now positive on the session, but that's only because we're off the opening lows. That's why. We're still down from Friday's close. Now take a look at the weekly chart last week of silver, and you could see that this rally, again, just like with gold, is just beginning to get going. Natural gas gapping down. No great shock. Jeff, as you're well aware, we were stopped out. The only position that hurt us last week, and it was minor relative to the gains that we saw, the natural gas took a tumble, and we stopped out on Thursday, and the price just kept dropping. Wow. Big gap. 6%. Wow. So we closed out. We had a covered call trade that we had made some profits on, good profits on, and That was our hedge on the position. We also had profits on a naked put position. We closed that out. We reestablished that same naked put position, but at a uh, much lower price than where we closed out the position, but a smaller position. We reduced our size. So I had hoped to see a rally here on natural gas to sell a naked call to create a strangle on the position, but it doesn't look like that's going to happen. We'll see whether or not we get an oversold bounce here. It's probably going to happen. And we'll take a look tomorrow, Jeff. We'll take a look at where we're at on historical support levels on natural gas. Maybe we'll add to that naked put position on weakness, then look for that counter trend rally. Maybe not. It all depends upon where we're at in terms of historical support. If we're not at historical support, we're not going to go leaning more into that trade. We're just going to manage it. Simple as that. Trader Isaac, hello Bob and all. Have you watched Tulsa King? I have not. I want to. Is it good? I want to. TZ Burton, hello sir. I'm glad I took a small oil spoiler. Yeah, smart. If it, when you have oil prices and uh, natural gas prices and the XLE just not cooperating, they're beginning to break down while the markets are moving up higher. There's something wrong, and I think what they're telling you or telling us is that the global economy is weak and getting weaker. We're going to talk more about that in a moment, but let's get through the futures action. So natural gas getting hammered. And I'll tell you right now, if I was still long of the common stock of BOIL, which is a leveraged ETF, which magnifies this move, and I had the naked put position on the size that I did, I'd be upset right now that I didn't listen to my instincts. We listened to our instincts, we exited the position, and we live to play another day. And we'll take advantage of the weakness. Hi, Bob. Boyle is at low 35. Plan to add Monday. You're probably going to get it cheaper than 35 on Monday morning. And how you doing, Tom? Okay, let's move on to agriculture. Wheat is getting annihilated. The wheat production, I saw a satellite image out of the Ukraine. Wheat production over in Ukraine was far greater than what was anticipated. So avoid wheat. Wheat's going lower. Very bearish chart. We are in a bear market on wheat, which is good for the consumer. Taking a look at soybeans, again, weekly chart. We flashed a continuation move up higher last week, but we reversed, and we're trading right at the support level that we've been hugging for quite a while now. The trend is still up, but it's a little bit wonky right now. As for corn, we were in a very tight triangle formation, and we broke support last week. Avoid corn. We want to avoid these names now. We spoke about copper prices last week, and we expected a move up higher. And man, did we get a move up higher? Nearly a 1/3% move up higher on the week last week, and this looks like it only wants to go up higher. So copper bullish. I skipped over protein, live cattle futures. I mean, wow, we were bullish on this, pardon the pun, but we remain bullish. It's going up higher. It's loving this lower band of support. Every time it taps it, it reverses right off of it. The bull market, again, pardon the pun, unintended, and the futures markets for cattle are heating up, and that's why we want to go into. That was an intended pun. Heating oil, of which I need to buy more of, and now I'm timing the market. I'm arbitraging my play here on home heating oil. Do I call up my distributor tomorrow? I don't think so. I think I pressed the trade here, and I think that I wait because we broke down the week before last. Last week, lethargic, but we're unable to close back above support. It looks like home heating oil is going to come in. So we'll keep an eye on it, and I'll let you know when we decide to call in that distributor. Hopefully, we don't run out of fuel oil. Now, before we leave here, I want to check back in with the dollar. Here's the weekly chart of the dollar. Sorry for all these crayon marks here, but net bearish price action. Expect more weakness on the dollar this coming week. Let's take a quick peek at the Japanese yen. Japanese yen, a very strong move up higher. We're at resistance. We may pause here. Euro. The euro broke out last week, folks. This is the largest component that trades against the dollar in the Dixie basket. So as goes the euro, in general, goes inversely the US dollar. Hey, Lewis. Hope all is well with you. Thanks for joining in. Weather is getting cold. Yeah, natural gas usually tends to play along with the weather, no doubt about it. Pat, hey, Pat. Hey, Bob, did very well in BA last week. Good. I'm glad you did well. The defense names are looking really, really good. It's scary. You got to ask yourself why. I mean, Martin Marietta, Lockheed Martin, Boeing, they're all doing well. Aerospace doing well. Look at the ETF DFSE. I think that is D. This is a leveraged ETF, not for the faint of heart. DFEN. This is the aerospace ETF. Come on, mouse. Oh, you son of a... There we go. Take a look at this chart. Look at these tight Bollinger Bands on DFEN. And look at the breakout and the widening out of the Bollinger Bands on a weekly time frame. This is going up. This is a good-looking chart. We've been consolidating for quite a while now. We have broken out. This sector is going up higher. You got to ask yourself the question, why? You don't really want it to go up higher, but it's going up higher. Let's take a quick peek at 10-year yield declining for all the wrong reasons. The dollar did move up higher, now moving lower. And the VIX, I know you folks can't see the VIX because my head is in the way. The VIX is flirting with a breakout here, trying to break out. Does it get rejected? Does it break out? We don't know. We're not that smart. We wait for the breakout to occur. We act appropriately. That's it. The VIX is at the lows that we haven't seen in quite a while. Since the summer. So I think that what we're going to be seeing for the next couple of weeks is a lot of choppy trade until we get past the Fed meeting, and then we get into the last week of the year, which is that Christmas holiday and the last week of the year. So we'll talk about seasonality on the S&P 500 triple Qs in a moment. Now let's take a look at what we're coming up for, or what we're looking at this week. Oh, I have this up here, folks. I'm going to share this out. I did my top picks for the new trading week. If you want a deeper dive into these picks and when we're going to look to open these trades, stop out, enter, what's our price targets, join 14 days free, and you will get the alerts and you can have access to the price targets, stop loss point, and entry points. I have to update that. I just reminded myself, members, that'll be updated tonight or by tomorrow morning, probably. So that's our top picks. All right, economic data coming out this week. Tomorrow's the 5th. I'm such a genius. All right, this is my first peek at this. S&P 500 services PMI. Remember, any read below 50 is a sign of contraction. This number has been negative for months now. ISM Services Index, that comes out. Factory orders, that should be interesting. Remember, the reason why you had a positive GDP last quarter was that Inventories got built up way too much, way too much. And now they're going to have to come back down. So I suspect that we're going to get more weakness on GDP moving forward. In fact, you saw them reduce GDP down a bit last week. There was a final revision, I believe. Where is that? GDP. Actually, no, they increased it. I stand corrected. Only honest math here, no narrative. So I stand corrected myself. I fact checked myself. We get the trade deficit. Nobody cares about the trade deficit. What caused the stock market crash in 1987 was a trade deficit. Nobody cares about it anymore. Uh, Wednesday, productivity. That should be interesting. Unit labor costs. Watch out for that one. You don't want to see that go up. I do, because I'm an American. I'm a blue collar guy down under my skin. But Wall Street does not want to see a rise of that number. They want to see people in poverty. That allows them to make more money. Jobless claims. That comes out each week. Friday, we get the PPI. That's the producer price index for November. That's the measure of inflation. It's the measure of input costs at the producer level. The question is, does that get passed on to the CPI? For a long time, it wasn't getting passed along. Now you're seeing that pumped into the CPI. We're going to get the UMIS sentiment survey for December. Watch wholesale inventories. That's the reason why GDP grew so rapidly last quarter. Expect that to probably come in pretty strong, unless these companies are really reducing inventory by price cuts. Nike is, I can't wait for their earnings report. We just shorted Hibbett Sporting Goods, HIBB, because they have 10% of their exposure. They take on 10% of Nike's inventory. So they are very, very exposed to price cuts over at Hibbett. So we are short of them. Yeah, they should care about it, but with the Federal Reserve that prints anytime that they need it, they don't care. You know, the old school, old guard that cared about any type of fiscal discipline, they're gone. It's long gone. But it's going to have to come back. Also, when time is right, OPEC meeting, I will add to old ILU. Okay. Is a wild card on Boyle, but 35 is right by the line with market maker. Okay. Okay. That's you guys chatting. All right. Yeah, I think Boyle is probably going to see the 20s. I think I'm probably going to take possession of some shares of Boyle again, which is fine. But I'm not going to be able to take possession of those shares probably until February, because I took a loss on that trade. And if I accept possession of those shares, which expire on, is it January the 20th? Actually, I could take possession. I need 30 days. No, I can't take possession. I'll have to roll the trade out until February and then possibly take possession of the shares then. So that way I get the tax write-off and I get the shares back cheaper. But I can't take possession within 30 days of realizing the loss on the trade. All right, valuations of the market. We're just shy of a 30 mark here, folks. Just call it 30, right? We're very expensive. We're in a profits recession, and that's why you're seeing valuations so lofty. We have not had the washout yet. People think that we have, and we have not. S&P 500. Let's go to the seasonality. This is brought to you by TrendSpider, 35% discount below. Get seasonality and automated technical analysis. You're looking at data going back. We don't want 4 years. We want much longer than that. Get rid of all this outlier stuff. $19 years. That's good. We're up 68% of the time. And I think you go back down to 17 years, it's at about 70, 71%. Let's take a look at the trip queues quickly. The trip queues, the month of December is not as friendly to the triple Qs as one might hope. Let's take a look at how we look on a weekly historical time frame. How well does this week work out? We are usually down on the Q, only up, I'm sorry, up 50% of the times on Qs going back 19 years. So it's a 50-50 shot. The odds improve going into the final 2 weeks of the year and up dramatically that final week of the year on the Qs. So this is valuable information. If we get a big sell-off on the Qs and you want to put on a short-term swing trade, you know, step into the breach, put on a position, and enjoy the seasonality ride up and into the back half of the year. It's just one trade thesis. Let's take a look at the S&P 500. Again, weekly view, seasonality. This week is generally better, up 56% of the time. The next week does not trend up with the Qs. The Qs tend to outperform the second to last week of the year, but then the final week they trade on par with the trip Q. So that final week of the year is a very, very bullish week, light volume, thin trade. The computers are in charge. The Wall Streeters they've headed on their Lear jets over to Stad, Aspen, and they're skiing. They're just keeping the market in check. Earnings this week. AutoZone is the only thing that interests me in terms of an earnings trade. We have not been trading earnings in advance of earnings. We've been trading the earnings news. If there's a dramatic event, meaning a big sell-off on AutoZone, then we'll look to take advantage of the implied volatility that should still be in the options price at the opening price action. So there's a matter of timing that gets involved, and we normally close out that trade by the end of the day. We're using front week options if they're available. I'm not sure if they're available on AutoZone. We'll have to do that research. Smith & Wesson, that's the Strumman Ruger rallied last week. I don't know if Smith & Wesson did, but looks like the gun stocks are coming alive. I didn't do any analysis on them. GameStop, I don't trade those meme stocks. What else do we have? Costco, definite trade. Lululemon, definite trade. DocuSign, definite trade. Broadcom, definite trade. Chewy, a maybe. Chewy is one of our top 5 stocks going into the new trading week. We would not advocate the purchase of the common stock in advance of earnings. Wait until earnings are in the rearview mirror. You do not want a binary event ripping you apart because you bought in advance of earnings. Whenever I see somebody on CNBC, one of these salesmen, come on and say, buy a stock in advance of earnings, I want to choke them, theoretically. Figure of speech. That is not a threat to violence. So don't go buying these stocks in advance of earnings. Please, please don't do that. I didn't go over this on Thursday night, but it's important to do so. And I was really surprised that the market shrugged this off. This is the Federal Reserve's balance sheet, and man, it cratered last week. They took a big chunk and they just dumped it onto the market. And the markets absorbed these treasuries last week. That's a big drop. $30 billion around there. 5-year look. We are at what appears to be can't say multi-year lows yet. No, definitely not multi-year lows, but certainly the lows of the year. All right, threats to the market, folks. I went over the yield curve on Thursday night. I went over it on Sunday night. We're going over it again tonight. For the benefit of those that aren't familiar with it, I want to get people prepped for what's coming down the pike. And for those that have watched this before and you're shaking your head saying, I can't believe he's going to go over this again. I do it to reinforce our opinion of what is coming down the pike in 2023. I mentioned earlier that when that jobs report came out on Friday, I looked for a bounce in the market. I automatically opened up a short position using the long dated put options on the spiders, one lot, small position. I'm happy now that I did that because I'm able to sleep at night. I want to wake up on a Monday morning worried about what headline risk is out there, and I don't have a sufficient hedge on. We also went short of the energy stocks. So those are our two large short positions relative to Hibbert, which is a small short position, HIBB, the symbol. Elliott Wave International, this is their tweet. This is old data. This goes back to October of this year. But this is the move index. And don't ask me how this is calculated. All I do is I look back at where we're at in a relative basis. And you could see that when we spike long-term capital management, that was back in the 90s. We spike 9/11, WorldCom default. For those of you that were not old enough to remember, WorldCom was a major telecommunications company. Bernie Ebbers was the CEO. I'll never forget this guy. He was on CNBC, treated like a god. He was there at least once a month, and handcuffs, died in prison. Iraq war. Then we saw the great financial crisis. Then we had the COVID meltdown. We're on par right now with the COVID meltdown. We are on par with where we have been a number of times before, if not higher, to cause us to say, buckle up, get ready. There's something very, very wrong out there. And I spent some time. I didn't want to go by October data, so I did some fishing around. I wanted to find updated data to share with you. This is it. I can't zoom this out. Hopefully you could see it. And we have pulled back from that October high. Actually, no. Yeah, we have. We have pulled back off the yearly high, but we are still elevated relative to the financial crisis and prior crises in the past. So this is the move index saying there's something wrong. There's something not right structurally with the world economy, the U.S. economy, a mixture of both. Who knows? Probably both. When you take a look at, I don't agree here with Alan Levinson. I follow him. He puts out some good stuff on Twitter. The yield curve is unwinding. I don't agree with that. I'm not seeing that yet. Way too early to make that call. The yield curve is still inverting. And historically, the most inverted the yield curve has ever been is where we are right now. Again, the bond market is saying there's something very, very wrong. And here's the S&P 500. And this is one of the reasons why I opened up a short position, because let's remember where we're at. We are in a bear market on the S&P 500, and where we closed out the week last week was just shy of weekly resistance. Now, last Thursday, I went over a chart. I think it was last Sunday. I went over a chart of back in 2008 where we actually broke out of a declining downtrend channel on the S&P 500, only to roll back over and give it up. And that was the final tank of the market. So you can see here, this is Financial Conditions Index. I believe this is put out by the Federal Reserve. And you can see that the financial conditions are rolling over. Again, there's something structurally wrong with the economy. And here we are back at the yield curve. And as you can see, there's no unwinding here. We are pretty much at the lows of the period. I mean, at one point last week, we saw, and for those not familiar, the yield curve is signaled every single recession when it inverts, meaning 2-year Treasury yields pay more than 10-year Treasury yields. This is the 2s versus 10s. And when it inverts, as noted by these gray areas here, I have the S&P 500 overlaid in gray, gold overlaid in gold appropriately. So when you begin to see a steepening, a rising of the yield curve, that's when bad things happen. And in general, there's a theory out there, and George Gammon addressed this on a video. George Gammon, really good video he put out, and I took this screenshot from him, so I must give him a shout out. I stole this from him. This is on my website. I posted it there. If you want to reference it in the future, I will share it. Okay, so the majority of declines in these bear markets occurred after the Fed's pivot. So a lot of people are out there, they're predicting a Fed pivot. The markets right now are pricing in only one more interest rate increase. And Jerome Powell already said it's going to be small. It's not going to be 3/4 basis point. Is it 50 basis points? Is it a quarter basis point? Probably a half basis point. But you go back to bear markets past, the Federal Reserve, and this is why the yield curve steepens, right? It goes up. But what also happens is that whatever caused the Federal Reserve to get spooked also causes the stock market to roll over. So this goes back to the 1970s. So I don't want to go through all of these. Fed pivot down 36%. Most recently, Fed pivot back in the dot-com crisis, we were down 51%. They over-tightened then, and that's what killed the dot-com bubble along with year 2K. Then we had the great financial crisis, down 58%. COVID, down 35%. Here we are again. And the Fed's funds rate is higher now than it was back in COVID. And think about all the additional debt that we have now versus back in 2020. It's insane. Yeah, they're winding down the balance sheet, but relative to what it looked like in 2020, it's still one big fat giant bubble. Now, I'm not going to get political here, but I'm looking at reasons why we need to be concerned about the market. And what's breaking on Twitter is just astounding. We always knew it. We always knew it. And this is not just a pox on the Democrats. It's also a pox on the Republicans as well, because they use the levers that were put in place over at Twitter to silence people. But the Democratic Party used it far more. And you have a level of corruption in government now that is now out for the world to see. And it is just, I'll share this out. I don't want to spend too much time on this because I don't want to get wonky political here. This should not be political. This should be apolitical. The government is censoring the U.S. taxpayer, the U.S. citizen. The government, according to our Constitution, this is what makes us so unique. The government is not supposed to know who we are. We are supposed to know everything that they do. The Constitution puts limits on the government, does not put limits on the U.S. citizen. They are breaking the law. So the question is, as the pressure ramps up and the people wake up to what is being done to them, what is the next crisis that they will create to take the attention off of this, which is a time bomb, and put it elsewhere? Will it be another, a war? Who knows? Who knows what it's going to be? These are arch criminals that are in charge, whether it be at the World Economic Forum, in Washington, D.C., both parties. I don't care. They got to go, meaning they got to be voted out with a responsible election. By May next year, goods inflation will have disappeared, maybe, but the illustration here is showing that the Shanghai Containerized Freight Index is dropping like a rock. And yes, when you align it with the PCE, goods inflation, the PCE came out last week. That's the Federal Reserve's favorite inflation gauge. It tracks this fairly well. Good chart. I'll share this out. Let's go to some comments here. The lovely Jody. Welcome, Jody. Uh, yes, the media is totally ignoring it. Even Fox News, even Fox News, except for Tucker Carlson, to his credit. I was shocked when I heard this started under Trump. Well, not necessarily. This goes back to the 2016 elections. Fed chairman may need to retire. He could use a hybrid system. Gold should be put in to put off inflation. It's the way it was. And taking us off of that system, blame Richard Nixon. Blame Lyndon Baines Johnson and Richard Nixon for the situation that we're in right now. Don't blame Biden. Biden is just the outcome. Uh, if you don't like Donald Trump, don't blame Donald Trump. Don't blame Biden. Don't blame Obama. They are the outcome of policies that were put into place by Lyndon Baines Johnson. He wanted guns and he wanted butter, meaning he wanted war in Vietnam, and he also wanted the New Deal, whatever that Great Society of the New Deal. I forget which one. Franklin Roosevelt had one. I invert them sometimes, but he wanted lots of spending on social policies. He attacked the goddamn Fed president, Fed chairman. So blame him and then blame Nixon for basically putting the stake into the heart of the United States of America. God bless Elon for taking us on the world elite. Yeah, and think about it. You know, people say that we don't want migration. He's not born in America, but he's a great American. So legal immigration is great. They're the best Americans out there. LBJ was before I was even born. Unfortunately, I wish I could say the same. But yeah, if you go back, take a look at what he did. He was a demon. Biden got in, yeah, but who finances it, right? The Federal Reserve finances it. How can they finance it? They took us off the gold standard. That's the only way. So all of this is an outcome of them taking us off of the gold standard. Now, I titled this live stream Emerging Markets and why you should be looking at emerging markets ex China. This is one of them. This chart here is a clear reflection that China is slowing. I was going to play you some videos of the protests over in China, the draconian measures that they're doing over in China for COVID zero policies. I don't want to bore people and make it's honestly just sad. It's really horrible, horrible. And I didn't want to get everybody down, but I'm sure you've seen them. No sense rehashing what's going on over there. But in terms of their economy, U.S. manufacturing orders in China are down 40% in what a logistics manager described to CNBC as being unrelenting demand collapse. We're going over that. We're seeing that here, right? Asia-based shipping firm HLS recently told clients it is a very bad time for the shipping industry. China to U.S. container volume down 21% August and November. Chinese factories are shutting down 2 weeks earlier than usual ahead of Chinese New Year. So China is in dire straits right now, both politically with COVID lockdown, on so many levels. It's incredible. So what we're doing here is I've been a proponent of buying emerging markets ex China, and the product that I found was EMXC. That's the iShares Emerging Markets ex China ETF. So to illustrate why I'm more bullish on ex China emerging markets, I overlaid here the EEM, the performance of EMXC. That's again emerging markets ex China versus EEM. This is simply a performance chart. And you could see that EMXC is performing vastly better than EEM. And for the record, EEM is over 30% China dominated. So think about if you wake up one morning and China has launched a missile over to Taiwan and war is on. What happened to Russian stocks? Well, they ceased trading here in the United States and never to reopen ever again. So 30% of the EEM would evaporate overnight. So I don't even care if the EMXC was on par trading with EEM, basically tick for tick performance wise. I don't care that even if EEM was outperforming EMXC, which it's not, I don't want the headline risk. I don't want that in my portfolio. EEM is 30% China. End of statement. To me, it's uninvestable. Same thing holds true for the emerging market leveraged ETF EDC. We avoid it. As a matter of fact, I don't even review it anymore. We stay away from China for a number of reasons. And here is the reason why we really like emerging markets. The emerging markets we were not invested in. And during this rally, this is a chart of emerging markets ex-China relative to the US dollar. Here's the correlation. You don't get less correlated than emerging markets versus the US dollar. It is almost, 90%. So almost 100% inverse correlation. Dollar up, emerging markets down. Simple as that. End of statement. So we avoided emerging markets for quite a while until we saw the dollar break. Then we began buying emerging markets, and now we're going to continue to dollar cost average in, as the US dollar highlighted here in green is now underperforming the EMXC in terms of price action. Look at the volume, look at the institutional accumulation of EMXC relative to, well, I can't say relative to anything else, no, relative to the US dollar. All this is referencing is that lots of money flowing into emerging markets. Now, if we see a major sell-off in US equities and you get a steepening of the yield curve, does that make emerging markets immune from a sell-off? No. They can and probably will sell off as well. But they will probably rebound a lot quicker because the Federal Reserve's pivot is going to cause the dollar to drop, and that's going to cause emerging markets to go ripping up higher. Any pullback in emerging markets ex-China, to me, is a buying opportunity. I want my money overseas. I don't want it here in this corrupt system that we have right now. This needs to get washed out. I don't know what's going to pop this bubble. Technically, it's already popped. We just don't know who the villain will be. Will it be China? Will it be the start of a new war by us to get the picture off, or the focus off of the Biden administration, the DNC? I don't know. All I know is that the stars are in alignment here for a major, major event, and we are already beginning to position in getting ready for it. We're still going to trade long. We're still going to sell our premium. We're going to do our business, but we're going to have a nice fat hedge so that when this all goes poof, we have a short position. Now, one of the shorts that I'm going to be looking for is Apple. Apple is in big, big trouble. What was the last product that Apple came out with since Steve Jobs passed away? I mean, they keep reinventing or putting out new iPhones, but at some point in time, that's going to run its course. But they're moving their production out of China, some of it anyway. And according to this Wall Street Journal article, I find this hard to believe, but according to this Wall Street Journal article, Apple makes up 10% of China's GDP. I find that hard to believe, but that's what this article says. I'll share it out with you. This is behind a paywall. And supposedly, Apple is their largest taxpayer. So if you guys that have a Wall Street Journal subscription, you can look at that. So what's the play here? Well, if Apple thinks that, and we spoke about this going back to 2020, when COVID first happened. I was talking about VNM, Vietnam ETF, India. You want to buy those spaces, and they took off. I didn't buy them because I was worried about the dollar rally. And ultimately, they did pull back, but now we're long of the EMXC, so we're happy. So the company has been reportedly telling suppliers to actively plan on assembling Apple products elsewhere in Asia, primarily India and Vietnam. Folks, think about what's going on over in China. Outside of Foxconn, they have nets for employees that are jumping out of windows, killing themselves. How much are they getting paid? Probably not all that much. So I have to think that moving out of China is going to cause their production costs to rise. Think about it. And also, what pound of flesh are the Chinese going to take out of Apple on their exit out of China? If they make up 10% of their GDP, China's going to take a hunk of meat out of them. I don't know how they're going to do it, but they're going to want their pound of flesh. So the headline risk coming out of China for Apple and Apple's threat against Twitter to take them off of their app store, their public relations disaster with helping the government over in China to help suppress the speech of the Chinese protesters. This is Disneyland type stuff. This is why Bob Iger is back at Disney. I mean, this is complete and utter optical nightmarish scenarios. It's dystopian, and Apple's at the center of it. So what we want to do here is we want to take a look at Apple's performance relative to the triple Qs. And you could see that Apple versus the triple Qs, and that Apple is dramatically underperforming the triple Qs. So I would argue that as we proceed into the new year, perhaps not going into the final weeks of the year, as we go into the new year, we're going to be looking at short opportunities on Apple. Now, another chart I want to share with you. This is the China large cap ETF versus Vietnam weekly time frame. And you could see Vietnam or China is vastly underperforming China. And while they bounced back in recent weeks, the downtrend is clear and defined. So I expected this trend to continue. Folks, avoid China. I like emerging markets on a weak US dollar, but no China. And Apple, I think Apple is in big, big trouble, because when you take a look at Apple's business, the size of Apple's China business, it's been declining, but it's still, as a percentage of global revenue, 17% of their revenues, and it's declining. So Apple is in a world of hurt. Let's do some chart requests. How much time do we have? Got 9 minutes. See if I have anything in the members area. Then we'll go to comments in a second. Take a cloud. Franklin, Annalie, and HL. Oh, Larry, I missed one on Larry. PACB. All right, let's do this. Folks are going to be using TrendSpider Automated Technical Analysis. Use the link below. Get 35% off of your subscription. It helps support the channel, and it's a great, great product. So let's take a look at Annalie. Annalie is a REIT. This is a monthly chart. We have a new monthly higher high. We pulled back off the highs. Let's go to a candlestick view. I like it. I think it's going up. Weekly view. You got a little bit of resistance up here. right here, 22.14. We close above that mark, it's a buy. Another way to trade this is simply waiting for a pullback to the lower band of support and buying it around uh, between $20.50 and 21 bucks a share. That's what I would do. As a matter of fact, I would create an alert here, touch, bounce, keep a little bit of sensitivity. And we're good. I'll create another alert here. Looking for a breakout. We don't want any sensitivity. All we care about is a close above that mark. No intraday price action above it. Mouse is giving me trouble here. Come on, Mousy. I'll share this out with you. Okay. What else do we have? Daily view. Daily view. We're looking good here. And folks, this is the automated trend lines at work. I did not draw this blue line. This is the click of a button. Take them off, put them on. Rising up trend channel. We bounced off the lower band. It's looking good. I think Annaly's going up higher. HL. Elka Mining, looking good. I love the mining space. You're probing the upper band of the fractal trend lines. We had a good week last week, strong volume. The shares are under accumulation. There's more upside potential here, but it's limited. You're going to see a little bit of resistance at $6 per share. Would I initiate a position here? No, I would wait for a pullback on Helka. Daily view. We're trading up and through. These are the 2 standard deviation Bollinger Bands. I usually don't use those. Let's go with the 3 standard. Where are my 3 standards? There we go. All right, so there's our 3 standard deviation Bollinger Band. This could go up higher. I just don't like the fact that we do have resistance above, so I would be a little bit concerned about that overhead supply. Yes, Lewis, please. Thank you, folks. Please smash that like button if you could. It helps me out with the YouTube algorithm. Thank you very much. Thanks for the reminder, Lewis. All right, that's Helka. PACB for Larry. I haven't seen Larry in a while. Larry, you on? PACB. This is an interesting chart. It's very interesting. Early stage. This looks like a biotech name. Biotech names are breaking out. So I like the space. And this is a monthly chart. We did a breakout here. We had another one here. We're right at resistance. We need a breakout, a monthly time frame. Where are we at on the weekly view? Yeah, we're right at resistance. I would not buy it here. I think a pullback and a retrace is the best bet. I like 985 per share. Daily view. Yeah, see, the problem here is that we broke out on Thursday of last week. Then on Friday, we gave up that breakout. It's a bit of a concern. And the biotech stocks were up on Friday. So this was showing relative underperformance on Friday. Watch for potential pullback here. Again, 980, 985, which is right down here. As a matter of fact, the automated trend line's in that neighborhood. It's flashing 966 as a buy point. I'll share this out just in case he watches it on the replay. Okay. TLT, strong price action. We'll come back to the daily chart. You saw a weekly breakout above the upper band of the declining downtrend channel. Very strong price action here. So it appears as though that this downtrend is nearly done. What we need is a pullback, a retest of the support level, if not a pullback and a higher low to get put in on a weekly time frame. Then we need to break out to new higher highs. We'll be in a new bull market if and when we do break out and above 120, 80, let's call it 121, round it up. Volume was very strong last week. Daily view. Again, automated trend lines. Bob, take them off. We broke out above one resistance level. We have multiple resistance levels above here. So a lot of the easy money's been made here. You're not going to get a lot of premium by selling puts, but if you want a reduction of basis cost, look at, and if you want the shares, yet you want to use a Groupon to get those shares or a coupon to get those shares, look at selling a put at the 105 strike. If you want to be a little bit more conservative, look at I don't know if they have 102.50s. If they have the 102.50s, maybe you want to sell those puts, but I doubt they're going to have those. It's probably 100s. It's probably going to be $5 wide strikes. So look at the 105s and or the 100s. I think they may have dollar wide strikes. Let's check this out. Oh, they're gonna have 102.50s. Very good markets in here. Very, very liquid. Jesus Christ, give me a break here. 102.50s. They have them. So if you wanted to sell the 102.50 puts, that's right at the support level. If they're assigned to you, well, you just reduce your basis cost. That's one play. There he is. Where you been? You're welcome, pal. NUGT. Obviously, I'm a big fan of Nugget. We've known it for a long time now. It has broken out. I would be a buyer if you're looking at a price point to buy them at on a retest of the weekly breakout point at 35.39. This is another one where you could sell premium, reduce your basis cost. The trend is up. The dollar is weak. I will say this: the dollar is it's at its midpoint of support. If it breaks support, it's going to considerably lower. But you expect a defense of the dollar fairly soon. So I would advocate, if you want to buy the shares of NUGT at this point, I would use naked puts and reduce my basis cost. That's the way I would trade it. And you get some good premiums in there. Daily view looking good. We bounced off of support again. The value of the automated trend lines for those just joining in. TrendSpider we're using 35% discount code below. So the path of least resistance is higher for Nugget. It's a good looking chart. It's going higher. Just be careful with your accumulation. I would truly advocate selling naked puts and legging in when they're assigned to you. Last chart for Pat. Oh, this is actually for Art. All right, for Artie. Tesla. You're welcome, Jody. Have a great night now. Be well. Okay, Tesla. We have a position here for disclosure purposes. We have a strangle on this trade, options trade. It's basically a neutral trade. As a matter of fact, I'm probably going to have to roll up puts on this trade tomorrow because we do have a breakout. Weekly time frame. Actually, no, not quite. We're right there. This is what, the 20 period moving average? Not sure what this is. This is a VWAP. We closed above a VWAP. We're right at resistance. So if we close out the week above 194.55, it's a buy. But this is another company that, let's face it, they are in the target of the government now. And I don't think that it's an investable company. I just don't. I think when you get the government that's on you, I would expect that Elon Musk, you have a political DOJ. They're probably going to file charges on him for something or other to wrap him up, threaten him, and ruin his day, ruin his year, ruin his career. And I'm worried. I'm really, really worried. So Tesla, speaking from a chart perspective, we broke out on a daily time frame. We're bouncing around. Looks like we're probably going to move higher. Odds favor bulls. Let's wrap up with comments. If I can get my mouse to work, I'll touch a comment here. Larry, at S&P around 3600, I would hope to get involved again. Smart move. Smart move. Great Depression incoming, buy gold, buy land. Definitely. Franklin, have a great night, my friend. Talk to you tomorrow. NG catching a bid after the bounce. Back over VWAP. Okay, we'll check that out in a little while. TZ Burton, have a great night, man. Everybody have an awesome, awesome evening. Thanks for being here. I'm honored. Like, subscribe, etc. You know what to do. Have a profitable trading week and have an awesome night. Be well.